Hello, this is Giorgio Lucas, and welcome back to my YouTube channel. And today I want to start by talking about the beginner's guide to the stock market. Now, I know for a lot of you, the stock market seems like something almost unreal. What is it? I really don't understand it. It's something I'm not going to ever invest in. I just want to tell you that I think the stock market is actually something you should invest in, because over a number of years, you will definitely beat instant access or deposit accounts. Maybe not over 1 year, maybe not even over two, but over a number of years, you will actually beat access deposit accounts, and you'll definitely beat inflation. If you take a period of 100 years, literally over each 10 years, the market has beaten inflation. Now, what is investing in the market? Well, in its most basic form, if we take one company, if you buy shares in a company, basically what you're doing, you're owning part of that company. So let's say there's 100 shares in a company and you buy one share, you own 1/100th of the company, and you pay a certain price for that, let's say £5. Now, £5 is usually the perceived value of what that company is worth per share. So, your share, if you pay £5 for one share, you've got £5 in that company. Again, this is a very small amount. You'll be owning a lot more because there's obviously charges and fees for buying shares. But I just want to keep that as a very basic example. So you own £5 worth of money in that company. So you're hoping that the value of that company goes up. So when the perceived value of that company goes up over a long time, and they're getting profitable and they're getting better known, you're hoping the price of that goes up. So the price of each share, which you've paid £5 for, if it goes to £10, well, you've doubled your money over a number of years. Conversely, if the company's not doing so well, the price goes down and you lose money. So this is what puts a lot of people off in investing in companies. And what I will say is that I've been burnt as well. I would not invest in an individual company unless I really, really, really knew a lot about that company and could dedicate a lot of time, hours, and meet managers of the companies. Most of us can't do that. So what I would say is don't really invest in an individual company. I've been burnt in the past here in the UK. I was burnt through the Northern Rock, had shares. As you know, there was a run on the bank. I think this was back in 2007, lost a lot. Whereas if you don't do that, if you invest in a number of companies, you should be okay, because even if one company goes bust, it's unlikely the others will. Now, going back to buying shares in one company, there's also what we call dividends. Now, dividends are basically money paid out from profits. So if the company makes, let's say, £100 profit a year, you own 1% of it, and the company decides to pay out all the profits in dividends, you'll get a dividend of £1. So you might think, well, okay, that's a basic example. Yes, it's a very basic example, and most companies will not pay all their profits out in dividends. What they will tend to do is they will reinvest the profits in the company, hoping that it will grow in the future. But dividends are a very, very important element of a company and of investing in a company. And in another video, I will show how important dividends are, because they really do add, especially if you reinvest the dividends in the company, they really add to your wealth. But now I just want to go a little bit away from individual companies, because I, like you, think it's a little bit too risky to invest a lot of money in one company. But we can invest in what we call funds. So we can invest in an active fund or a passive fund, and an active fund will invest in a number of shares which they think will outperform the market. And you usually have a portfolio manager. You can have a passive fund which usually will invest in an index. Here in the UK, that will be the FTSE 100. Or in the US, that could be the S&P 500. And what usually happens as an investor, when you're investing in a fund, you're buying basically a small piece of a number of companies. So what you're doing, you're minimizing the risk that if one company were to go bust or to perform particularly badly, hopefully the other 30, 40 or whatever companies are left in that fund will make up for it and go up in value. Again, from this, you'll get dividends from each company. Many fund managers will allow you to either have that as income, and which a lot of the older generation do. They like income from their investments as almost like a pension. Or those of you who may be a little bit younger and who want to reinvest all those dividends for the future. Now, I think if you're in your 20s, I think you should reinvest all your dividends, especially if you're looking for a good retirement in the future. But if you're in need of some income, which you may be doing in later life, and almost like a kind of pension, then it's better to take income. But going back, you're investing, remember, you're in a fund, could have as many as 50 to 100 shares, especially if it's a tracker. You're investing, you're basically owning. Think of when you're investing in shares that you're becoming kind of an owner in the company. This is so fundamental because people have this perception, I'm buying shares, but what does that mean? Well, in effect, you're owning part of that company, and it gives you a right to vote. Let's say you can oust the chairman, your vote. Obviously, I know one vote theoretically will not oust the chairman, but you, in effect, almost like a voter, you are an owner, you vote in the company. You can even decide its future, whether to split the shares, repurchase shares. All these decisions you will be involved in. In reality, though, it tends to be the institutional investors that have a say in what happens. But strictly speaking, you are an owner in the company. So again, this is great because you now are beginning to understand what it means to own shares. Now, shares must never be, I say must never, I think when you buy into a fund, a lot of people are trying to look for a quick profit, and this can happen, but I think you should always stay invested for the longer term. You're much more likely to either beat the index or perform a lot better than an instant access fund if you stay invested for the long term. One last thing I want to say about owning shares is that do not get attached to any particular fund manager or shares. At the end of the day, this is what I did as well when I was a bit younger. I got attached to some shares, to fund managers, and when they started to perform badly, I said, no, I'll stick with them and see it through, because I thought I had some kind of attachment to them. You don't. If you think something is no longer worth investing in, don't, leave it. As for example, what happens if you read the financial press with Woodford, good for many years, started to go bad. Thankfully, I got out of that. I had no emotional attachment to Woodford, got out of it, and at least made some money. In the next few videos, I will be talking about active versus passive investing. I'll make a brief video there, and I'll be doing investment trusts versus unit trusts. Please let me know in comments below, or email me if you want to talk about any other subjects concerning investment, and I'll be more than happy to do so. Anyway, I'll see you in the next video concerning active versus passive investing. Thanks very much for watching, and bye for now.